When you look around the world and you think about the emerging markets, the dollar story has been a massive factor. There's idiosyncratic stories that relate to a number of key markets. Brazil, what's happening in Argentina, what's happening in Turkey. But EM is still rightly or wrongly perceived as a kind of single bucket. And money has flown out of it as a result of the dollar. You talked earlier on about the diversification trade. There's a number of big investors over the last few days and weeks that have come out and said, now is the time. This is a once-in-a-cycle opportunity to get into EM. Would you agree with that?
So when we think about EM, we look at it in two ways. You know, a big area of focus for us is really looking at EM when it comes from a credit perspective. And when you look at where valuations are for EM credit, we think it's quite attractive at this point. There's been a significant sell-off throughout the beginning part of this year. A big part of it has been driven by the fact that the Federal Reserve continues to raise interest rates, and high-quality dollar assets have become more attractive relative to some of the alternatives. And EM suffered because of that. So, our team, when we think about investing in EM, we think there's value there. Credit has cheapened up quite a bit. We're looking at where it stands from a historical basis. We're somewhere in the neighborhood of about the 70th percentile. And we think fundamentals ultimately look pretty attractive there as well. When you think about funding needs over the short term, we're thinking 6 to 12 months or so are compelling from a technical standpoint. So we do think emerging market credit at this point has value. But it's been a space that's been driven heavily by momentum and folks chasing performance ultimately.
Aren't you concerned about a rising U.S. dollar? You forecast a rising U.S. dollar that's not exactly great for emerging market countries that have a ton of debt in dollars as their currencies weaken. And as the Fed keeps raising rates, that's got to suck funds in as well, right? Or out of emerging markets.
And that's basically what we've seen so far this year. But we also think that, again, valuations at this point in time have become more attractive, at least on the credit side, that should ultimately allow investors that are looking for value to look at the emerging market bond space as a place that offers value relative to the other alternatives.
Is China just different when it comes to this story? China's adopted very different policies in terms of money moving in, money out. There's a bunch of factors that are different.
China is a market where it's still highly controlled, and to your point, it's money moving in and out is highly controlled, whether or not it's through quota or other factors. And so, again, it's a managed economy, and so when you think about economic growth in China, our base case for this year is somewhere around 6.5%. We do expect that we will see continued, market flexibility opening up over time. And ultimately, we expect that when you see what's happening with, some of the broader market indices, whether or not it's the Bloomberg Barclays Global Aggregate, which is expected to add Chinese government bonds sometime in 2019, April 2019, we will expect to see more flows going into that market from international investors.
Greg, I want to get in. I don't want to miss the chance to ask you about passive versus active investing. I used to love to interview Jack Bogle all the time on this, and he was pretty adamant. But I think history shows that there are times when passive investing outperforms. Those times have been long and profitable. There are times when active investing is maybe a good idea. Where do you see us in this market right now as far as active versus passive?
The story really never changes between active and passive, and we actually do both, and we advocate for both. The big difference is that in order for active to have success, it needs to be low-cost active. We do believe there's an opportunity for active managers to add value. The problem is much of that value is destroyed by high fees. And so we think there's room for both, but it has to be, when it comes to active, low cost. And as long as the majority of the alternatives when it comes to active management are high cost, you're going to see that investors continue to gravitate more towards indexing because they understand the probability of outperforming by high cost active management is quite low in the long term.
How's MiFID II working for you guys? Sorry, Matt.
Well, I just wanted to ask if ETFs are a great answer to that. I mean, do you think that ETFs are able to keep costs down? Are they a good way to passively invest?
We think it's a great way. We manage funds as well as ETFs, and we're agnostic between, the two different approaches. Ultimately, again, low-cost investing is a great thing for investors around the globe, and we've been advocating that since the very beginning of Vanguard, and that's what our approach is all about, is continuing to lower the cost for investors around the globe, and we think ETFs are a great vehicle to help accomplish that.
MiFID 2, sorry, let's go back to that. Sure. Like, transparency is meant to improve. It's meant to improve the visibility we have on the market. Is it kind of, I can't remember how many months we are now into it. What does it look like from your end of the stick?
We think greater transparency in the marketplace is absolutely a good thing.
Yeah, that's hard to argue with.
Yeah, that's absolutely.
MiFID 2 delivering kind of the right way of achieving that?
From our perspective, it is a good thing from, again, providing greater transparency to investors to understand ultimately what their costs are going to be in a variety of different structures. We think is a great thing for investors to have transparency when it comes to those types of factors. So, when we think about markets in general, when there's a case for transparency versus no transparency, Vanguard has always been advocating for greater transparency when it comes to understanding what's happening in markets and costs and fees and things of that nature.